Welcome to my YouTube channel where I study the best investors from around the world. Today we're going to be talking about passive investment again, and guess who we're looking at today? Jack Bogle, formerly known as John Clifton or Jack Bogle. He was an American investor, business magnate, and philanthropist. He was the founder and chief executive of the Vanguard Group, and Jack Bogle was credited with creating the very first index fund. So let's understand his investing philosophy and get down to business. Now, it's no secret that the stock market right now is currently smashing through all-time highs, and as a market is so expensive, we're currently looking at a Shiller PE, or price-to-earnings ratio, of around 35. And what that means essentially is investors are willing to pay realistically double for the S&P 500 as to what they would normally pay for it historically. We're also seeing a Wilshire GDP ratio, a Buffett indicator, of now 200%. Which is just insane. Considering a fully priced stock market is about 100% and a cheap stock market is like 50 to 60%. But here's the tricky thing. Most of us investors out here are passive investors. Passive investing is now by far the most common investing strategy in the whole world. It is diversifying across the whole market. It is the strategy of simply buying the whole market and just throughout your life showing up periodically and just continuing to contribute to that broadly diversified portfolio, or dollar cost averaging. The idea here is that we consistently invest throughout our whole life and we simply get the average market return. By doing that, there's no brain power or stressful findings and calculations involved. We're not trying to pick individual stocks, and we're not staying up at night and doing research on individual businesses. We're simply buying the market and going along for the ride. In all honesty, this method of investing has made a lot of investors a lot of money. It's made a lot of average Joe investors, people like you and me, a lot of money consistently over the long period of time. There's one important thing I've felt lately, and chances are you've probably felt this too if you're a passive investor. It's hard to make sense of these current times, where every metric under the sun is showing us that the market is really quite dangerously overvalued. It's been quite painful showing up and continually sinking more and more money into a market at these levels. So, how do we know if the market is so overvalued? What if there's a massive correction around the corner? Do we persist even in these times, or do we kind of chill out and maybe not buy ETFs until the market is seen to be not so dangerous anymore? Here's a good framework to answer these questions. Since the market is approximately 2x overvalued versus historical norms, let's see how the grandfather of passive investing, Jack Bogle, explains it instead. John Clifton Bogle was an American investor, business magnate, and philanthropist. You all probably know him quite simply as the founder of the Vanguard Group and thus the founder of low-cost index fund. And thus, the person that started this whole movement of low-cost, accessible passive investing. You may not have heard of him before, and in all honesty, when we think about people like Warren Buffett and Charlie Munger, he doesn't really get the mention among most famous investing names. However, he really should. Because by far, he has helped more people on this earth create substantial wealth than any other investor. In 1997, Jack Bogle made a speech, and what struck me was he was talking about how passive investors should go about their investing at times where the market looks pretty dicey. Listen to how he describes the market conditions that he was seeing then in 1997 and see just how well it matches up to what we're seeing in the stock market today. Jack Bogle says, in short, it seems to me that speculation on betting on higher and higher valuations is in the driver's seat. Investment on betting on the fundamentals of dividend yields and earnings growth is in the backseat. But when speculation drives stock returns, in the short run it drives stock returns. The crystal clear lesson of history, at least in the past 200 years, is that in the long run, fundamentals drive returns so that tension has to be resolved. He was talking about the run-up towards the tech bubble. What we're currently seeing is market returns. The market is being driven up by speculation as opposed to people investing for the fundamentals of these businesses. If it stands this way, this gives us two possible future scenarios. One, prices will, at some point in the future, align with intrinsic value. So yes, there are going to be periods of time where even if we just talk about the market in general, the price on the market will be substantially higher than its intrinsic value, and we'll also have times where, number two, price of the market is below the intrinsic value. As we see from history, as time goes on, it runs through cycles of being overvalued and undervalued. But the thing for sure is that at some point in the future, the price will once again match up with the intrinsic value. But in times where the market is really overvalued, what that means is it gives us two possible future scenarios with the idea that at some point in the future, prices will once again match up to intrinsic value. Here are Jack Bogle's thoughts on the two possibilities during the tech bubble. So that tension has to be resolved. Let me give you two extreme possibilities. Number one, a market drop of 35%, just for the fun of it. This would lower price-earnings ratio to a more normal level of about 13 times. Number two, we're in a new era of the stock market which returns 15% to 14% earnings growth and a 1% dividend yield, rather than the long-term historic norm of about 10.5% to 6.5% earnings growth plus 4% dividend yield. In short, a new era of boom times and high valuations that would justify today's price levels. Now, of course, this could happen, but I wouldn't bet the ranch on it. The U.S. stock market, however, seems to be betting the ranch on it. It's priced, I think, for the best times and only for the best of times. His definition fits pretty perfectly into the 2021 investing environment that we're currently seeing. He goes into a bit of detail there, but he's still essentially just talking about two potential possibilities. Number one scenario, the price is higher in the current intrinsic value, and what we can see within the market is that it's overvalued. That is, the price is much higher than the current intrinsic value. This is scenario number one. You can see the stock price of the market fall so that, again, in the future, that we'll see that price meet the intrinsic value, or on the other side of the scenario is number two. Number two scenario, boom times. Business growth is rapid across the market and intrinsic value rises to justify the price. What we could see is a new economic boom time where businesses are able to grow very quickly. Say not the 10% per year ranges, but more in the 20 to 30% ranges. And that increased growth lifts the intrinsic value of the business and therefore the market, and then the intrinsic value rises to meet the price. These are two ways that the price can once again meet the value in an overvalued market, but then that begs a question. What should we as passive investors do about it? Should we still be investing, or should we be holding off and waiting it out? Well, luckily for us, Jack gives us 5 timeless tips that should help passive investors navigate even the most expensive of market situations. As Jack Bogle explains, let me close with 5 simple principles, a few ideas of what you might want to think about, principles of investing that may help you first invest. Tip number 1, you must know that the biggest risk and a long-term risk of not putting your money to work at a generous return, not the short-term but nonetheless real risk of price volatility. Even if those stocks seem very high, consider what I said in my book, a little plug there. Never think that you know more than the market does. You have to be wrong if you do. So, step 1, keep investing. The biggest risk you can take right now is not investing at all. I love this tip, and I wholeheartedly agree. I believe that no matter the weather, passive investors should continue to show up. Remember, it's the ability of the strategy that we follow to work across decades and decades, regardless of what market conditions we see, and that makes this strategy just so powerful. So absolutely the number 1 tip, and I totally agree with Jack when he says this, no matter what the market is doing, there is a far bigger risk in not investing than continuing to invest. If you are a passive investor, don't stop. Tip number 2, give yourself all the time you can. At the extremes, if you're in your 20s, begin to invest in stocks. You've only got a little bit. If you're in your 60s, invest more in bonds and less in stocks, but always remember that compound interest is a miracle and time is your friend. Second tip, time is your friend. Who cares what happens tomorrow, next week, or next month across even the next year? It really doesn't matter for passive investors. Passive investors should always go back and look at what the ultra long-term trends of the stock market are and buy into it. buy into the long-term trends. If you're able to do that as a passive investor, basically everything looks great no matter what the starting point is. Pick your starting point, go back through the history, say the S&P 500 or the ASX 300, pick a starting point wherever you like. You can pick the highest of the highest starting points, and if you zoom out across 20 to 30 years, it really doesn't matter where you start. You're pretty much always going to be making money. Tip number 3, have rational expectations of the future returns and be mentally prepared for market declines. Always remember, in good times and in bad times alike, this too shall pass away. I spend a full page in my book on this sage piece of wisdom. This too shall pass away, and your emotions can kill you. You should keep them out of your investment program because impulses are your foe. Your emotions can kill you. I love this quote. Impulse is your foe. The reason that passive investing works so well is that the strategy is impervious to emotion. You just show up, you keep investing, and it works. In fact, the only time when passive investing throughout history has not worked is when the investor has been sucked into doing something stupid through their emotions and has ended up not following the strict passive investing dollar cost averaging approach. So don't let that happen. You're definitely a better investor than that. Tip number 4, rely on simplicity. Simplicity above all. There are too many witch doctors in this business. Basic investing is simple. A sensible asset allocation to stocks and bonds and reserves, a middle-of-the-road selection of diversified funds, a careful balancing of risks and returns, and lest we forget cost, which can kill long-run returns too. The 4th tip, stay diversified. You could do this by just buying one single ETF. You can get exposure to every single stock in the entire market from wherever you are at, right? If you can buy one stock and then you can track the S&P 500, you can buy one stock and achieve massive diversification with economies of scale. Now it's easier and cheaper than ever before to get into these low-cost index funds, especially when you're looking at companies like Vanguard or BlackRock. You really can't go wrong. It's easier and cheaper than ever before. Tip number 5. When you followed all of these 4 rules, as I said and I've meant, and 1,000 times, and if not 10,000 times, no matter what happens, stay the course. Step 5. Just stay the course. I always say that passive investing is one of the easiest but also one of the hardest strategies to follow. It's very simple. It requires no brain power, so in that aspect, it's a very simple stock market investing strategy that is proven to work and generate great returns. But it's very hard to stay disciplined and continue to show up periodically in those same time intervals. Investing that same amount following that dollar cost averaging strategy, that is where the difficulty lies in passive investing strategy. It requires a lot of discipline to stay the course over decades and decades and decades to get that wealth building that we're all in it for. So tip number 5, just stay the course. So overall, these are Jack Bogle's 5 timeless tips that should help passive investors out literally in any market condition. To really hammer home his points, I wanted to do an example. Imagine you are someone sitting in the room in an audience and listening to this speech in 1997, and imagine if you're sitting in the crowd listening to Jack Bogle thinking the same thing. No. I'm still not going to buy in because the market's too expensive. I know what long-term wealth creation is, but it's just too pricey right now. Well, even if you bought in at the most expensive point, you bought into the S&P 500, and at the most expensive point in 1997, what would you have achieved 23 odd years later? Well, let's look at this. You would have had a good time initially in the run-up before the tech bubble, but then you would have had a very bad time when the tech bubble popped. Then you would have enjoyed a nice run-up again before the global financial crisis tore everything apart. You would have been down again, and you would have had some turbulent emotions going on at that time, and you would have hung in there, and over the last 10, 11, 12 years, you would have just seen a fantastic run-up to where you would be. Well, back then, at the highest point in 1997, the S&P 500 was at 983 points, and now in 2021, The S&P 500 is at 3,800 points. So it's almost 3 times higher in 23 years. Okay. If you invested $10,000 in the S&P 500 when it was at its highest point in 1997, the year that Jack Bogle gave this speech, and you just held on through thick and thin, 23 years later, you'd now be sitting here in 2021, you'd have about $40,000 to your name, and what did you have to do in the meantime? Nothing. You would have just had to stay invested, and you would have made a 4 times return in 20 years. That's why Jack Bogle says, block your emotions and just stay the course. But anyway, I thought this was an interesting example to finish on. These are Jack Bogle's timeless tips for passive investors to navigate every single market condition, even if the market is falling off a cliff. Even if it's an all-time high like we're seeing right now, all 5 of these principles apply. So I definitely encourage you to really listen to him. He's the grandfather of passive investing, so take what he says on board, and it will help you out with a lot of your passive investing. That's it for this video. Remember, if you enjoyed watching this video and this channel, don't forget to hit the like button and subscribe and enable your notifications to get first-hand content on this channel. Thanks for watching. See you in the next video.